They appeared to move quietly while broader public attention was elsewhere. While markets celebrated year-end rallies and analysts debated Federal Reserve policy, something fundamental shifted in the architecture of global commodity flows. The shift wasn't announced in press releases or highlighted in quarterly earnings calls. It happened within less visible operational segments of derivative markets and custody vaults, in the gradual multi-quarter accumulation patterns that only surface months after the positioning is complete. This discussion is for educational and analytical purposes only and does not constitute financial advice. On December 28, 2024, J.P. Morgan Chase filed routine regulatory disclosures that revealed a transformation so dramatic it points toward a significant strategic realignment within the bank's commodity desk. For nearly 2 decades, the institution had maintained one of the largest short positions in precious metals derivatives markets, a positioning strategy that generated consistent profits while providing liquidity to industrial users. That strategy, which had weathered multiple market cycles and regulatory investigations, was not merely adjusted or reduced. It was meaningfully inverted. The bank that had spent years betting against rising metal prices had quietly assembled what appears to be the largest long position in silver derivatives in modern financial history. The accumulation, spread across multiple quarters and executed through various trading entities, represents approximately 750 million ounces of exposure. To understand the magnitude, consider that global mine production typically yields 830 million ounces annually. A single financial institution had positioned itself to benefit from price movements in an amount approaching the scale of an entire year of planetary extraction. But the positioning itself, while unprecedented, tells only part of the story. The timing reveals something more significant about the forces reshaping commodity markets in 2025. J.P. Morgan's dramatic reversal occurred during the same period that Chinese export restrictions began targeting critical materials, that industrial demand for advanced battery technologies accelerated beyond prior projections, and that supply chains demonstrated increasing challenges responding to non-linear demand increases. We are witnessing what appears to be a phased transition in how financial institutions view the relationship between paper contracts and physical materials. The old model, where derivatives markets could effectively manage price discovery independent of underlying supply constraints, may have reached practical limits. When the largest player in the space abandons a strategy that had proven profitable for decades, the implications extend far beyond a single bank's profit and loss statements. The technological shift driving this transformation centers on solid-state battery chemistry, specifically the role of silver in next-generation energy storage systems. Unlike conventional lithium-ion batteries that use liquid electrolytes, solid-state designs require metallic interfaces to prevent dendrite formation. These microscopic crystalline structures, which develop during charging cycles, represent the primary technical barrier preventing rapid charging and extended battery life in electric vehicles. The solution that Samsung SDI, Toyota, and other major manufacturers have developed involves silver-carbon composite anodes. The silver component serves as both a conductive matrix and a lithium host, allowing ions to deposit uniformly across the electrode surface. This prevents the spike-like dendrites from forming while enabling the battery to charge in minutes rather than hours. The chemistry is elegant but inflexible. Silver's unique properties, its ability to conduct electricity while remaining chemically stable under extreme conditions, are currently difficult to replicate through substitutes. Copper lacks the necessary stability. Gold provides the conductivity, but costs prohibitively more. Platinum group metals offer some similar characteristics but exist in even smaller quantities than silver. This technical requirement transforms silver from an industrial seasoning, used in small amounts across thousands of applications, into a structural component of the global energy transition. The quantities involved represent a fundamental departure from historical usage patterns. Traditional automotive applications require roughly 15 to 30 grams of silver per vehicle, primarily in electrical contacts and window defrosters. Solid-state battery systems, depending on their configuration, may require between 200 and 800 grams per vehicle. The distinction between laboratory breakthroughs and industrial scaling deserves emphasis. Solid-state battery technology has existed in research facilities for over a decade. The recent developments involve manufacturing processes that can produce these batteries at automotive scale. Samsung announced production lines capable of delivering batteries for 500,000 vehicles annually by 2027. Toyota has indicated similar capacity targets. These are not experimental programs but long-horizon, multi-year industrial investments. Market pricing mechanisms, however, operate on different timelines than industrial planning cycles. Financial markets typically respond to quarterly earnings and immediate supply-demand imbalances. Industrial users plan capacity years in advance and secure materials through long-term contracts that may not be immediately reflected in spot market pricing. This temporal mismatch creates periods where paper prices diverge significantly from physical availability. The demand mathematics reveal why J.P. Morgan's positioning shift may reflect institutional recognition of structural changes rather than speculative positioning. Current global silver consumption approximates 1.1 billion ounces annually, with industrial applications accounting for roughly 600 million ounces. Solar panel production alone consumes approximately 140 million ounces per year, a figure that has doubled since 2020 as photovoltaic installations accelerated. If solid-state battery adoption follows historical patterns for automotive technology deployment, the demand implications become apparent quickly. Conservative estimates suggest 10% market penetration by 2030, representing approximately 9 million vehicles globally. Assuming an average silver requirement of 400 grams per vehicle, this translates to roughly 115 million ounces of additional annual demand. Moderate adoption scenarios, where solid-state batteries capture 25% market share by 2030, would require approximately 290 million ounces annually. Aggressive scenarios, particularly if charging speed advantages drive rapid consumer adoption, could push automotive silver demand above 400 million ounces per year. These figures exclude potential applications in grid-scale energy storage, where solid-state systems may offer advantages for utility-scale installations. The supply constraints that make these demand projections significant stem from the geological and political realities of silver production. Unlike many industrial materials, silver mining cannot expand rapidly to meet increased demand. Exploration programs typically require 5 to 7 years before producing the first ounce. Major mining projects often take a decade or more from initial discovery to full production. Current global mine supply has remained relatively stable near 830 million ounces annually for the past 5 years, despite significant price increases during that period. Ore grades, the concentration of silver in extracted rock, have declined consistently over the past 2 decades. Mines that produced 15 ounces per ton in 2000 now yield closer to 4 ounces per ton from similar deposits. The geographic concentration of production adds complexity to supply expansion possibilities. Mexico produces approximately 23% of global silver, followed by Peru at 18% and China at 11%. Political stability in these regions directly impacts global supply availability. Recent policy changes in Mexico have restricted new mining permits, while Peru has experienced periodic labor disputes that temporarily reduce output. Recycling provides some supply cushion, but operates under different constraints than primary mining. Silver's industrial applications typically involve small quantities dispersed across millions of products. Unlike gold, which tends to be concentrated in jewelry and coins that can be easily collected and reprocessed, silver exists in microscopic amounts in electronic devices, solar panels, and automotive components. The recycling rate for silver approximates 20% of annual consumption, significantly lower than gold's 90% rate. The economic threshold for silver recovery often exceeds the metal's value, particularly when considering the energy costs of extraction and purification. Solid-state batteries, while containing larger quantities of silver than traditional electronics, will remain in service for 15 to 20 years before reaching end-of-life recycling. Historical precedents suggest how markets respond when new technologies create step function increases in material demand. The deployment of catalytic converters in automobiles during the 1970s created unprecedented demand for platinum group metals. Palladium prices increased from roughly $200 per ounce to over $1,000 per ounce between 2000 and 2001 as automotive applications expanded faster than mine supply could respond. The development of fiber optic communications generated similar dynamics in rare earth markets during the 1990s. Erbium, previously a laboratory curiosity, became essential for optical amplifiers. Prices increased exponentially until alternative technologies and expanded production restored balance several years later. These transitions share common characteristics that appear relevant to current silver market dynamics. Initial demand increases typically exceed supply response capabilities by significant margins. Price volatility increases during the adjustment period. Financial markets often underestimate the persistence of supply constraints, assuming that higher prices will quickly incentivize additional production. The psychological pressure phase emerges when market participants realize that traditional pricing relationships no longer apply. Silver has historically traded at ratios between 50 to 1 and 80 to 1 relative to gold prices. These ratios reflected silver's dual role as both a precious metal and an industrial commodity. If solid-state battery demand fundamentally alters silver's industrial consumption profile, historical price relationships may become progressively less predictive over time. The confusion this creates extends beyond commodity markets into broader economic planning. Central banks model inflation based on historical commodity price relationships. Industrial companies budget material costs using established trend lines. When underlying demand structures change rapidly, these models can produce misleading signals for extended periods. Skeptics often point to potential technological alternatives that might reduce silver requirements in solid-state batteries. While research continues into alternative anode materials, the timeline for developing and scaling substitute technologies typically exceeds the timeline for deploying current solid-state designs. Companies investing billions in manufacturing capacity are unlikely to delay production waiting for theoretical improvements that may never achieve commercial viability. Others question whether electric vehicle adoption will proceed as rapidly as projected, noting infrastructure limitations and cost considerations. However, solid-state battery technology directly addresses the primary consumer concerns about electric vehicles, charging time and driving range. If these technologies deliver promised performance improvements, they may accelerate rather than slow electric vehicle adoption rates. The regulatory environment adds another layer of complexity that traditional market analysis often overlooks. The Chinese export restrictions taking effect in January 2025 target critical materials used in advanced technology applications. While silver is not explicitly listed, the restrictions create policy and regulatory precedents for resource nationalism that could affect any strategically important material. The broader trade tensions between major economic powers suggest that supply chain security will increasingly influence industrial planning decisions. Companies may prioritize securing material supplies over optimizing costs, particularly for inputs that could face export restrictions or trade disruptions. J.P. Morgan's positioning shift appears to acknowledge these structural changes in ways that pure financial analysis might miss. The bank's commodity trading operations have historically profited from providing liquidity during market stress periods. If silver markets are entering a period of sustained physical tightness, the traditional strategy of shorting paper contracts while maintaining minimal physical inventory would become increasingly risky. The accumulation of such massive long exposure suggests institutional recognition that physical silver availability may become the primary driver of price discovery rather than derivative market sentiment. This represents a fundamental shift in how major financial institutions view the relationship between paper contracts and underlying commodities. The implications extend beyond silver markets into broader questions about how financial systems adapt when physical constraints begin to exert greater influence than monetary policy alone. We are observing what may be the early stages of a transition where material science and industrial physics impose limits that financial engineering can struggle to offset efficiently. The transition now accelerating through global supply chains represents more than market adjustment. It marks the emergence of physical constraints that financial engineering cannot readily solve. When material science begins dictating economic outcomes, the traditional tools of monetary policy and market intervention become incrementally less effective at the margins. We are witnessing the early stages of this transition, where the laws of chemistry and thermodynamics impose limits that no amount of capital can quickly circumvent. The Chinese export restrictions scheduled to take effect on January 2, 2025, create a new class of strategic trade measures. These are not traditional tariffs designed to adjust trade balances or protect domestic industries. They target the foundational materials required for advanced technology production, introducing supply-side leverage considerations into trade policy. The timing suggests coordination with broader geopolitical objectives, but the consequences extend far beyond diplomatic posturing. China's dominance in rare earth processing provides leverage that transcends conventional trade relationships. The country controls approximately 85% of global rare earth refining capacity, despite producing only 60% of raw materials. This processing bottleneck creates choke points that affect every advanced technology sector, from electric vehicle motors to wind turbine generators to specialized high-performance systems. The export restrictions specifically target gallium, germanium, and antimony, materials essential for semiconductor manufacturing and certain high-reliability applications. While these restrictions do not directly affect silver, they establish precedents for resource nationalism that could expand to other critical materials. When nations begin treating industrial inputs as strategic assets, the assumptions underlying global supply chain planning evolve rapidly. The semiconductor restrictions demonstrate how quickly technological supply chains can be disrupted. Gallium arsenide semiconductors enable high-frequency applications in radar systems and satellite communications. Germanium provides infrared capabilities for both civilian and institutional-grade systems. The quantities involved are relatively small, measured in tons rather than thousands of tons, but their absence can disrupt entire industrial sectors. Silver's role in advanced battery systems creates similar vulnerability profiles. While silver mining occurs in multiple countries, the refining and processing infrastructure concentrates in fewer locations. Switzerland processes approximately 40% of global silver into industrial forms. If geopolitical tensions expand beyond current boundaries, these processing choke points could become points of commercial and logistical sensitivity. The January 2nd implementation date coincides with the peak production season for solar panel manufacturing, an industry that consumes approximately 140 million ounces of silver annually. Chinese manufacturers dominate photovoltaic production, controlling over 80% of global capacity. Export restrictions that affect silver availability could create cascading disruptions through renewable energy supply chains precisely when deployment acceleration is considered essential for climate objectives. The technological requirements driving silver demand operate independently of geopolitical tensions, but interact with them in complex ways. Solid-state battery chemistry cannot be modified to accommodate political preferences or trade restrictions. The silver-carbon composite anodes require specific material properties that exist regardless of diplomatic relationships or economic sanctions. This inflexibility distinguishes current commodity pressures from historical trade disputes. Previous trade wars typically involved products where substitution was possible or production could be relocated. The fundamental chemistry of solid-state batteries creates dependencies that cannot be easily circumvented through supply chain diversification or alternative sourcing strategies. The industrial planning cycles involved in solid-state battery deployment extend beyond typical political timelines. Companies committing billions to manufacturing facilities must secure material supplies for decades, not quarters. These long-term commitments create institutional momentum that persists through changes in government policy or trade relationships. Samsung's investment in solid-state battery production exemplifies this dynamic. The company has committed approximately $15 billion to manufacturing facilities designed to operate for 30 years or more. These facilities require consistent silver supplies throughout their operational lifetime. The investment cannot be easily modified or relocated if material availability becomes restricted. Toyota's parallel investments in solid-state technology create additional demand pressure. The company plans to begin commercial production in 2026, with capacity targets that suggest annual silver requirements exceeding 50 million ounces once fully operational. These commitments were made based on assumptions about material availability that may no longer hold if export restrictions expand. The automotive industry's transition timeline creates particular vulnerability to supply disruptions. Electric vehicle adoption has reached inflection points in multiple markets, driven by regulatory mandates and consumer preference shifts. Solid-state battery technology promises to address the primary remaining barriers to widespread adoption, charging speed and driving range. If material availability constrains solid-state battery production, the consequences extend beyond automotive manufacturers to encompass national policy objectives. The European Union has mandated the phase-out of internal combustion engines by 2035. Similar policies exist in California, the United Kingdom, and other major markets. These regulatory commitments create political pressure to secure material supplies regardless of cost. The defense implications add another dimension to material security concerns. Advanced military systems increasingly rely on the same battery technologies being developed for civilian applications. Solid-state batteries offer advantages for military equipment, including reduced fire risk, extended operational life, and improved performance in extreme conditions. The convergence of civilian and military demand for identical materials creates competition that transcends normal market mechanisms. When national security considerations enter material procurement decisions, traditional cost-benefit analysis becomes secondary to availability assurance. Military procurement often operates under different budget constraints than commercial applications, potentially driving prices beyond levels that civilian industries can sustain. The recycling limitations that affect silver supply become particularly significant when viewed through national security perspectives. Unlike strategic petroleum reserves or grain stockpiles, silver cannot be easily stored in large quantities for extended periods without incurring significant storage costs. The metal's industrial applications consume it in forms that make recovery difficult or economically unviable. Solid-state batteries, while containing larger quantities of silver than traditional electronics, will remain in service for 15 to 20 years before becoming available for recycling. This creates a temporal mismatch between current procurement needs and future recovery possibilities. Material consumed in 2025 will not return to supply chains until 2040 or later. The mathematical implications of this temporal displacement become apparent when considering deployment scenarios. If solid-state battery adoption follows the typical S-curve pattern for automotive technologies, the steepest demand increases occur during the middle phases of market penetration. This suggests that the largest material requirements will emerge between 2027 and 2032, precisely when recycled material availability remains minimal. Historical analysis of similar technological transitions provides context for understanding current dynamics. The deployment of catalytic converters during the 1970s created unprecedented demand for platinum group metals. The transition occurred over approximately 15 years, during which palladium prices increased by factors ranging from 5 to 15 times their initial levels. The fiber optic revolution during the 1990s generated similar patterns in rare earth markets. Erbium demand increased exponentially as telecommunications infrastructure expanded. Prices remained elevated until alternative technologies developed and new production capacity came online, processes that required approximately a decade to complete. We have crossed the threshold where theoretical constraints become operational realities. J.P. Morgan's positioning shift suggests institutional recognition that material physics now governs market dynamics in ways that traditional financial engineering cannot override. The convergence of technological demand, supply limitations, and policy-driven resource controls creates a framework where industrial chemistry increasingly dictates economic outcomes more powerfully than monetary policy or short-term market sentiment. The old equilibrium, where paper contracts managed price discovery independently of physical availability, appears to have reached its structural limits. What emerges next will likely reflect the stubborn mathematics of material science rather than the fluid preferences of financial markets.